Well, hello, everyone. Welcome to this edition of TNL Talks, Trowbridge Law Firm. I'm Gene Trowbridge of the law firm, and we're securities lawyers. And we have a whole series of interviews on our YouTube channel of important people in our industry. And today we're happy to have a CPA. We're having Chip Simmonds with us. Chip is out of the San Antonio area, and Chip and his wife, maybe I shouldn't have said that, but I'm for sure his wife is in the real estate business and a syndicator, and Chip is full-time a CPA. And we're happy to have Chip with us. You'll see on the back of the slide his contact information at the end. At the end of the interview, we will post more contact information. And just for your information, Chip, when we're done with this, we'll edit it and we'll put it out there on our YouTube channel and broadcast it to the world. So, Good afternoon, Chip.
Good afternoon. Friday.
Yeah, it's nice to see you. I see you at conferences walking through the hall and everything, but this is very good. Well, Chip and I are going to talk about three things today. We're going to talk about this new rule where you have to register with the IRS, the Treasury Department, so that they know who is who in the world of LLCs and entities. No one is trying to dodge taxes. I'm sure that's what it's all about. And then we're going to talk about the passive loss rules. This is a good time of the year to talk about how investors, passives, are surprised when they get their K1 and they take their K1 to CPA and they find out that they can't use all of their losses. And then Chip's got some good news for us. He's got two new things for the taxpayer that'll be good for us. I think they'll be good for us because it's higher write-offs. So Chip, let's start out with, what do you call it? SinFin?
SinFin or FinCin, FinCin. It's the arm or the division of the Internal Revenue called the Internal Revenue Service called the Financial Crimes Enforcement Unit, FinCin. And what they're doing is they're trying to get a little bit more grasp or control, if you will, as to who's out there and what businesses are out there and who's made up of ownership within those businesses. So if you own, I believe it's 2% or more, they're going to want to know who exactly is what's called the beneficial owner. The beneficial owner is information.
2% or more of what?
Ownership of the business.
Of the business, of the LLC or sub S corporation, right?
Yes, a sub S corporation, a partnership. Those are going to be the ones that they're wanting to, or even a C corp. They want registration, within their financial crimes enforcement network or unit, so that they know who to kind of look for. If the whole point of this is to try to find where can we drill down on where there may be, say, money laundering or revenue that's not being reported, and by who. So they're asking for certain information for those beneficial owners, and that's what they're calling the owners that exceed this threshold of ownership within the business, where they need your social security number, they need your date of birth, and they want to go back as far as who started the actual firm. So imagine that. Our firm, Bill J. Simmonds and Company, was created in 1984 by my father. So when I register with the Financial Crimes Enforcement Network, then I have to put Bill J., his social security number, his date of birth, and all the beneficial ownership information that they want for him, even though he's deceased. But then subsequent to that, I'll point out that I am now a beneficial owner of this firm, and I'll report my social security, date of birth, and information that they want just to be able to have it. it may seem like a bit of government overreach, but they're
A
what
bit, a bit.
a
I
bit.
hear, I hear they want a copy of your driver's license.
That's
Uh,
correct.
that's what
Yeah,
we did ours. That's what we had to do. And so you register. To make a long story short, everyone's going to have to register. And like when I registered, I got myself a number. It's like a social security number or a tax ID number. It's whatever the number is called inside of this system. And now when I go to register all the LLCs that I'm involved with and in my one sub S corporation, they're going to ask about me. But if I already have a number, I'm just going to be able to put my number in there, kind of short circuit the data gathering, and then some other information and go on. Well, the if you have an LLC that bought a piece of property, you're going to have to register. If you had an LLC that was a managing member of that property, of that LLC, you're going to have to register. If for some reason the LLC has bought a couple of properties and they all have single purpose entities, we're all going to have to register. It's a burden. It's going to be a burden. What about the people that started LLCs prior to the 1st of January this year, where this law really takes place?
so it kicks in. It was supposed to kick in 1 January, and if you create a business subsequent to 1 January or 1 January on, then they want you to register as soon as possible. Initially, they said 30 days, but they backed all away from that, and now they're giving 90 days. So it's very important. There's some heavy fines involved too. So we're still working out the kinks on this, but right now, as it sits, if you create a business in 2024, you have 90 days to register with the Financial Crimes Enforcement Unit of the Internal Revenue Service or the Treasury Department. Um, there's a link. I can send that to Jim, where to go, and there's links for frequently asked questions. But a, a little grace, or I guess patience that they've provided on this registration. If you created your business in 2023 and beyond, you have until December 31st, 2024 to register. So what I'm telling my clients that already have their businesses established, wait. I'm not saying we're not going to register, but let's tap the brakes and let's see how things play out. And all the kinks are worked out, and we finally get a final, okay, this is how it's supposed to be done, and this is the ending information that we want. If you have your business created prior to 2024, you have until December 31st, 2024 to register with the Financial Crimes Enforcement Unit of the Treasury Department. So if you're creating a company in this year, an LLC, partnership, C Corp, then you have 90 days to register. And I don't quite understand why they're requiring that, but I think it's because firms that a lot of people just don't have their original documents as to when a particular company was created. So they're allowing a little bit more time to the end of this year to get that registration paperwork pulled together and the pertinent information that they want. And they think, if you're creating one in 2024, you already have all those documents. You have the principal owners and their information readily available and readily to report and register with the Treasury Department.
I think another reason that I thought of, and I'm just making this up, is that if you're filing right now, you are going to have your final tax return done for this entity that you're filing by October. So they got to have it. They got to have it so that when you file your tax return for this year, they have your information. Generally, the previous years you've already filed, so that would just be historical keeping. Well, one of the things that we did in our fee agreements with our clients, we have a section in there that says after we file the Form D, we're going to have to file state notices with the SEC and the states, telling the states that we've gone into your state and are raising money from your investor. Big red stuff in the fee agreement that you need to provide us with information so we can do that. We've added a section right under there and just as big red letters that you have to do this. We're not doing it. This is an IRS Treasury deal. I'm not doing it. I think that some CPAs who represent syndicators are doing it. I think some people aren't doing it. Are you doing it?
I'm going past at this point because it requires a verification of information. So I'm going to recommend most of my clients, that they use their attorney, or that they approach their CPAs if they have, if somebody's just asking me. So there are some extra steps to make sure that the information that is submitted is true and accurate and correct.
Yeah.
And if a taxpayer or client doesn't have very good records, I may be hesitant to report that for.
One thing I've seen is that the registered agents, we use a particular registered agent anytime that the client doesn't want to be the registered agent themselves. And that company, a national company, is providing that service to everyone for whom they are a registered agent. And I do know a couple of law firms that want to make a business out of this and are looking to do that, but that's not our law firm, and I don't think that's your CPA firm. So this is just an alert, like a missing person alert on your phone. Beep, 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 beep. You have to do this. You have to be ready to do it. If you're just filing something, and don't forget about all the other ones. I was telling you before we started that I have a client for whom I've done 164 offerings since 2014. And they came to me and asked me if I was going to do that for them. And I said, no, but I don't think it's going to be all that hard because they're going to get their number. It's a corporation, and they're going to get their number, and then their corporation has been the managing member of all this other stuff. So once they get their first number, I think it's going to be relatively routine for someone in their office to do it themselves, but it sure sounds like an overwhelming task. Okay, enough of that. Thank you for that. Now, I want to go back to a story. The story is I've had a chance to invest in an apartment building. The PPM said that we were going to use the most aggressive cost recovery methods we can. We're probably going to use cost segregation, and you should check. A good PPM says you should check with your accountant and see if this is going to do you any good. Something like that. And so we do that, and at the end of the year, we get a K1. And the K1 reflects the amount of taxable losses that are attributed to me. And I look at that K1 and I said, my God, that's great. That's equal to the amount of money I put in, just to be conservative. It's equal to the amount of money I put in. This is just great. So I take my K1 and I take it down to Chip and say, Chip, let's do my tax return. And when I get my tax return, I find out that I'm not able to take all those losses currently. I'm not able to take all those losses currently. So I'm going to call Chip and say, what the hell? And you are going to tell me what?
Well, there are two buckets of revenue. One bucket of revenue is your W-2 income and your investment income, like dividends, interest, and those are all in one bucket. The IRS created a second bucket back in 1986 with a big tax law change that created passive losses and passive income. So you have these two buckets, and you can't intermingle the two unless certain requirements are met. So assuming that those requirements aren't met, you just have these two. So this bucket can't offset your active bucket. So this one's out. Now you're just dealing with, say, rental properties and limited partnerships, those all fall in a passive bucket. And a passive bucket is anytime you have an investment that's generating maybe some revenue or some losses that you have no material participation in. The syndicator or the operator, they're the ones doing the managing the property, and the rentals fall into this passive by default. So the only thing that you can intermingle with the passive bucket are passive gains and passive losses. Those can be offset every year. However, what we see with real estate is we see a lot of losses, especially at the very beginning of the operating period for that investment, because of the magic of depreciation, the phantom expense that is not cash, but it generates a loss. So sadly, the IRS made this change, and they did it for a quick reason. I'll explain. Back in '86, they wanted to close, say, the loophole that doctors and attorneys were using to invest a lot of their money that they're making into depreciable assets, like investments that they had no management in, the real estate. And they closed this loophole and they created these two buckets. So now you can't intermingle this, and that's because they wanted to add to the tax base so they could make more money from doctors, lawyers, and high income individuals. So sadly, if you don't have passive income, you don't get to take the passive losses to offset each other. And generally, what we will see is a lot of losses that just get suspended. They're called suspended losses, and you don't lose them. You just have to carry them forward on Form 8582. So if you have any of these passive income or passive losses, 8582 is a very important form in your personal tax return. You should look it up, and it will tell you on line 3 what is your loss carry forward. And this is a tool that you can use to make decisions on what to do with real estate, whether to sell, or if you sell, do you have losses that have carried forward from prior year that will offset the gains on the sale of real estate within the current year. So 8582, it's a fabulous form. Everyone should know it. It's a very important form because it tracks the losses that have been disallowed by the IRS uh, because they can't offset your active income bucket. So they just go move forward until they can be used. And when they can be used is when you sell a property and you have a gain, that income can be offset with those losses that have been carried forward. So uh, uh, it's important, and you'll see a lot of syndicators, and I'll point this out. They'll do a cost seg because they have multiple partners, many partners that they don't know whether the cost seg, if the depreciation, accelerated depreciation, and the loss that's generated, if all partners will not be able to use it, or if some of the partners will be able to use that, because they may have some very high passive income. So if you have high passive income, you want to see passive losses from other real estate investments. So I get a lot of questions as to why would you want to do a cost seg if not everybody can use the losses generated from that cost seg. Well, the answer is we don't know. We don't know. Like Kelly's operation, she has 64 partners, and I don't know what their involvement is in real estate. So they may very well need more losses because they have a year where they have a lot of passive income. So if you're in a position where you've got a lot of passive losses, then it's, there are ways to go out and find investments that may have passive gains, and you invest in those and they generate passive income, but you offset it, you avoid tax on it because you've already got losses that are being generated through your real estate. So
When that law first came out, there was a big discussion. Well, we're going to go sell people pigs, passive income generators. Yeah,
thanks.
and it might not be real estate, but it's anything that, last year we syndicated a hockey team. Okay, we helped syndicate a hockey team. Well, that's not real estate, but it's a passive investment. And who knows if there's going to be income from that. So if I get it right, the first place you look at is you have your active and then you have your passive. And the rule is they don't commingle. You can't use the passive to offset the active. But everything that's passive can be offset by passive losses, passive income and passive losses go into the same bucket. They offset each other. And if you only have one investment, when you sell that, you'll be able to take all your passive losses that are suspended against the income from the sale of that asset. Now,
That's
if you
correct.
have two, and you're having all this accumulated loss from asset A and your suspended losses from asset B, and you sell A, you can put A in your passive basket and use all the losses there are from both properties, right?
Right. Yes.
Well, so there's some tax planning that goes there. And Chip, you and I know people that are in some of the organizations we're involved in that have 20, 30 passive investments. So the CPA work, the bookkeeping work, and the allocation of that and getting whatever that form is correct every year is a can of worms. It's a lot of work. And so we all appreciate that. But that's the reason, and people panic, oh my gosh, I don't get to use the losses. Well, I mean, the rule is not currently. And if they're not used currently, they're suspended to be used in the future. But the bottom line is you never lose, well, you never lose the ability to take those losses. I guess I don't want to get too deep in the woods, but I suppose if you sell a property at a loss and you have other losses that are suspended, you better call your CPA and see how that works, right?
That's correct. On that situation, yeah, when it just goes away, you don't want to lose. You don't want to lose any of those losses if you can.
It's
But
a timing, it's a timing game, isn't it? When you get
and
a number of things in your basket.
and this is really important. This is tax planning. When you do what Gene's talking about with finding these pigs, these passive income generators, it's really important. And it could be a restaurant. It could be a car wash. You know, Kelly and I are getting into washing machines. You know, a laundromat. We anticipate a pretty good margin, and that will offset some of our passive losses. So yeah, it's a tax planning tool, and it's being proactive, finding those pigs.
And I think one of the things that happens from all that aggressive tax planning in the early years is by year 5, 6, 7, and 8, that property is producing passive income.
Correct. Yeah.
Okay.
So the
And
longer
then,
you hold, the, and when you're in a real estate position and they do a cost seg, you're going to have accelerated depreciation, which is going to cause a larger loss generally. And then hopefully they're going to improve the property, they're going to improve rents, they're going to improve tenants, and the value is going to go up. There may be a refi down the road, but all of this is considerations. And when you've got you've grown your real estate portfolio, then you can anticipate if we sell a property in this year, let's make sure we either invest into another property that does a cost seg to help offset, or you just kind of anticipate. Look at where we are now, and if we just closed and sold a property in January, so it was fantastic. Closed in January. We've got a lot of time to plan in 2024 to offset those gains. If we don't have enough passive loss carry forward, that's on our 85, 82 tax form. So
another subtlety that I know is that people say, well, the only way I'm going to defer gains is through a 1031 exchange. You may not need a 1031 exchange. If your passive basket has enough suspended losses, you still may be able to sell a property, take all the losses, and have not deferred,
absolutely,
but tax-free.
That's the beauty of Form 8582, the passive loss activity limitations, the loss limitation. Look at line 3 on that page 1 of that form, and that can be used as a tool as to should I do a 1031, or hey, do I have loss carry forwards that don't require me to do all meet all the requirements the IRS has for a 1031 exchange, which is timing and very difficult to make sure, because if you don't dot your I's and cross your T's with a 1031, they could disallow it. But you may not even have to pay all that money for a 1031 if you've got the loss carry forward on that 8582 passive loss activity limitation.
Well, that's very exciting, and certainly bodes for people who are listening and who are passive investors to make sure that they're working with their CPA every single year. And for my clients who are syndicators, and I know my documents, and maybe you can never say it strongly enough because you can't hit the people in the forehead with a sledgehammer, but they always say, yeah, we're going to do all this stuff, but you should talk to your advisor to see when these benefits, these actions will benefit you. And
Absolutely.
yeah,
Yeah.
yep, I put in the risk section that it might not work today, but you're going to get those losses. Just be careful.
Yeah.
That's something, isn't it? Let's, and I was syndicating back then when the Reform Act of '86 came along, and the story was that the doctors and the high income people were investing in see-through office buildings in Houston because you could get a 4-to-1 write-off. And who cares if there are any tenants? With so many losses, it sheltered everything. We didn't have any income, and the government wanted to stop that. And how they stopped it is saying, if you're passive, you maybe can't use the loss this year, and you just need to suspend it. Just killed the business.
Yeah.
Just killed the business. So anyhow, so what are two things that are new that taxpayers should know about? I think they're
So
in this year, right?
yeah,
2000.
they just started the per mileage rate for business use of your personal vehicle. If you're a business owner, I use my vehicle quite a bit and track my miles, and for every mile I get 67 cents for business. That's a tax deduction. So it's gone up from 65 and a half cents in 2023. For 2024, it's 67 cents. So it doesn't sound like much, but if you put the numbers together, that's, for every mile you're getting, 67% of $1, which is, if you track it properly, it's a reimbursement to you for using your vehicle. And it's an easy way to get money out of your business without any income tax. There's no payroll tax and there's no income tax on a mileage reimbursement expense. I use it as a great tool. I track my miles every month, and after each month, or I usually will combine 2 months, I'll reimburse myself for the total miles. So let's just imagine a business owner drives 1,000 miles, 500 each month, 1,000 miles, and you do an expense reimbursement business to yourself because the business got the benefit of your vehicle. That's $670 that you could cut a check out of your business or request it from the business owner. He gets a deduction, and there's no payroll taxes. There's no income taxes. You're getting reimbursed for a cost of your personal vehicle. Now, if the vehicle is owned by the business and it's being depreciated, then you don't get this mileage rate. But for small businesses and business owners, it's a great way, and not very difficult to get money out of a business without paying any taxes to the government or to the state, Medicare, or Social Security.
If you take the 67 cents write-off, do you still get to deduct things like maintenance and your gas? Or
You don't.
is that it?
It's very important. And you can't switch from year to year. You have to decide, am I going to take mileage or am I going to depreciate? So if you take mileage, then your oil changes, those are all factored into that 67
Okay,
cents per mile.
that's what I
So
thought.
it's very important to keep that in mind. You can't go to Jiffy Lube and get your oil changed and get that 67 cents per mile. So it's a very important point, Gene, that you point out that
Well, I
and
think,
you can't depreciate either.
yeah,
Uh,
I think keeping track of the miles is a headache, but it's a lot easier than keeping every receipt that comes out of the gasoline pump machine when you buy gas and doing your oil changes. And if you have to buy a new car, you have a shoebox. I could get rid of my shoebox of car expense receipts and just take 67 cents a mile.
Yeah,
Interesting.
yeah, and just have a little booklet of I have a calendar. There's with smartphones, there's some pretty good apps out there that you can Google, find out track your miles. And even some that when it knows when you're driving, it'll ask you, hey, is this a business trip? And it'll prompt you to put in your beginning odometer, and then it tracks the miles and can spit out a report at the end of the month if you'd like. So look into those. It's a good way, like I said, to get money out of a business without any taxes.
That's great. So what's the last thing you have to tell us?
So in 2024, for business owners or people traveling, uh, the new simplified per diem rate came out by the IRS starting in October of 2023 and in 2024. If you're traveling to a high cost area, which is generally a city, Houston, San Antonio, Dallas, in the Texas area, Austin, um, they're giving a 309 per diem allowance. So the per diem is $309, which is made up of for a high cost $214 for room and lodgings, and the difference is meals and incidentals. So um, it alleviates, again, keeping track of receipts and all that. But you're allowed this amount if it's a business related trip. Now, if it's in a rural area that's not, say, as expensive, then the per diem rate is $264 a night. So again, this is an easy way and these are allowances. I track mine as allowances that you can keep track, and it simplifies a little bit some of the record keeping. You know, I was in this city for this purpose, for these nights, and here, rather than keeping all the receipts, the hotel, the taxi, the your breakfast, your lunch and dinner, you know, this all inclusive, 309 entails everything. So, uh, uh, I think it's a good number to know, and it's just starting in 2024. Uh, Something that a lot of people don't track, and they miss out. Or even if they stay at a less expensive or cheaper hotel, they can still claim this per diem. It's called the simplified per diem travel rate, and it's a good number. 309 for cities, 264 for kind of rural areas, and I use it quite a bit and plan on using it. Even going into all my trips that I spend going to Houston. I spend quite a few over there. I track that, and I have a brother that lives over there, so I usually stay with him. But that per diem sort of simplified. You don't have to actually have the hotel bill. Now, check with your CPA, because there are some reporting requirements if you're just a self-employed individual. Okay, but for C corps, partnerships, S corps, this per diem uh, it can be used, and there are some restrictions on self-employed individuals, which are like Schedule C, a little bit different. I'm not sure why the IRS did that, but making it a little bit more complicated for some.
All right. Well, that's all great. This has been a great half hour we've spent together, Chip. I really appreciate you taking the time. I know it's tax season and we're doing this late during your dinner hour at home, and I appreciate that. I know that you've got a couple people waiting for you for dinner. So everyone, this has been Chip Simmonds, CPA out of San Antonio. There's contact information on the screen, and we're going to add some more contact information to the end of this recording before we put it out on the YouTube channel. So once again, thanks very much. Say hi to Kelly for me, and we'll see you later on the next issue of TNL Talks.
Thank you very much for having me.